Well, I'm a big believer in your time is money and my time is money. So we're 11:01, 11:02. We're well over 100 people logged in, and we expect another probably 100 in the next few minutes to join us this morning. So on behalf of Eshenbaugh Land Company, our honor to welcome you to our May view. This morning we have a couple of special guests that we'll be introducing a little bit later on, and Willy, Nunn, and Philip Smith. That'll give us a perspective from their worlds that we live in it here. We're glad everyone is safe. It's interesting and fun to be emerging out of our 2 months of hiatus. As you look at my slide, we were bullish on my left slide going into 2020, and there's my big bull, number 22, standing on the left, contemplating his world back in March, or even early March. And on the right is my newest horse, Willy. And that's kind of symbolic of where we think we are now. We're saddled up and we're ready. We just haven't quite turned out to figure out what is next out in the field for us. But we think that our team here is ready to get back into the game of in the office. And I'm happy to be celebrating this morning, sitting in my office. We returned slowly last week, and we're back to pretty much full force here today in our office in Hyde Park, trying to be socially correct and distance and so forth. So again, we thank you all for joining us. We're trying to be compliant with all the regulations that keep coming out daily, it seems like. Working remotely has been fun. Got a lot of our aerials done. And so as this world evolves and changes, we're wishing you the best from here, and let's figure out what the next chapter is going to be for us as we move in through the end of May and into June. So people buy houses and tenants pay rent. That's a little bit contrary to some of the forecasts we saw on the worst of the doom and gloom back in March, where some forecasters had us believing home building was coming to a complete halt. No one buy a house in the time of social hibernating, and the tenants wouldn't pay April's rent. They wouldn't pay May's rent. Well, contraire, we're hearing a lot of reports about virtual home sales from start to finish, and we'll hear more about that later this morning. And I think surprisingly, especially particularly for the apartments, rent collections have not been horrible. Been 90% or better, we're told, in April, again in May. Now, I heard one yesterday. I was on a webinar where they were talking about a young tenant, very happy he'd paid his May rent. I asked him how he paid it. He said, well, I paid it on my credit card. Uh-oh, that could be a little bit of a warning sign that that can't last forever, but at least he's doing good faith efforts to live up to his obligations and pay his rent. So we'll keep seeing, I'm sure we're going to be monitoring the rest of May to collect what June looks like for us. So again, we continue to have all the discussion that's going on with the moratorium in parts of Hillsborough County and the impact fees that hopefully will get scheduled out and not be all at one time. I was on a ULI conference a couple of days ago where we're getting some input on that subject matter. But if that happens, we still think there's opportunity around us in Manatee and Hernando, Zephyr Hills, and Plant City. We're actually working on contracts with land in all four of those areas because we think that with the affordability issue, much lower impact fees in some of those jurisdictions, and a hospitable environment in those locations, that we'll see some of the housing market really start to blossom in those locations. So I gave you the stage advice from Willy Nunn. That's one of the reasons I love having him on the panel today. Was the old world is gone. That's what he told his team in one of his early emails to them, and that we have to learn to live with the new technology, Zoom and GoToMeeting and so forth. That there's an awful lot of technology being adapted that's really accelerating the pace that we live in. And I think a lot of those changes will be here to stay. Personally, I've learned to love Zoom. As I told you earlier, I thought Zoom was a snowboard competition in Snowmass or somewhere back in February. Now it's one of the greatest ways you get to see people virtually and have those discussions. So I think it's here to stay. Oh, the other way around, yeah, good. So we had a couple things we talked about 1 month ago with Cash is King. We're in the big pause. The active adult market has slowed down considerably, and some developers have stopped. But some builders are having some pretty good sales, and we'll hear some reports. Ryan did a survey in the last 2 days of our builder market, Tampa Bay area, as well as our apartment developers, and we think we've got some pretty good opinions of what's going on out there. And also, we again will thank our Tampa Bay Builders Association friends for the their work in the workplace compliance issues in order to get inspections and move forward. On a ULI meeting the other night, we heard from Hillsborough County. They think they'll be virtual for hearings by July. And it sounds like Pasco County is already there doing some hearings for planning and zoning. We did hear a comment last time that the credit scores are changing from 580 upwards, and that will impact us on down the road. Well, let's move forward. So our mid-May reality is that unemployment is headed toward, if not already at 25%, and a fairly significant mortgage default rate in place. Reduced consumer spending conference, the lowest since 1980, and a much slower rate of inflation. It's going to be a while, though, till the oil prices get back up to $40 a barrel. That probably will help us get some costs down in construction for the short term with low energy costs in terms of job sites and all the kind of things that impact us there. It's kind of nice to pull in and have a number that doesn't start with a 2 when you're filling up your vehicle. Mine holds 34 gallons, so believe me, it's fun to walk away, and it's not a $100 bill like it once was. So, thank you. So this was a slide I really liked for today, and this was John Burns of about 2 weeks ago. John had been slow to do a forecast, but John has some expectations, and one of them is that we're going to have 6 boom towns across the nation for residential development when we come out of our hibernation and coronavirus 19 impacts. And of those 6, 1 in Florida is Tampa Bay area, the boom town. The other ones are scattered across the country in Salt Lake City and up in the far northwest, Texas, Arizona. So we're pretty proud of that. We're going to stand way out from the crowd in comparison to the huge impacts on Orlando and tourism, Miami and international travel and so forth. So it appears that our job base, our job mix, our whole marketplace here is as favorable as it gets in this state. And I know some of the big national builders, they're having some discussions about having really tough times in New Jersey, New York, and places like that, and it's having some impact on how their corporate offices think about Tampa. So we'll have a little bit of discussion in Ryan's survey. We asked what companies are laying off, and without sharing who they are, that some are because it's a corporate policy having some impact on Tampa. Those who are based here, who have a really strong presence here, know how strong we're going to be, and we think some of the big national firms are going to look to Tampa Bay market to help carry them nationally. So lots of interesting dynamics going on. A lot of pressure, I'm sure, on some of the division presidents here to perform for the national builders as well. So with that, it's my pleasure to turn our team over to our principal, Ryan Sampson. Ryan will run the program and introduce our 2 guests and then give you the results of his early week survey. So Ryan, with the beard, you're looking great, man. You're looking ready for Gasparilla. It's on to you.
Well, thank you, Bill. First of all, I want to appreciate everyone attending us. We're trying to change it up, this format, instead of having just a market overview from one of the great economists that we've used in the past. We wanted some real world impact from some of our local players that were privately owned that aren't strapped with what they can and can't say. So with that, I will introduce our folks. Feel free to email me questions or use the Q&A box, and we will feed those to both Willie and Philip. I'll start with the introduction to Philip Smith. Philip is with Framework. He is the founder and principal with Framework Group in Tampa, and they are a multifamily apartment developer throughout the Florida market, and maybe regionally or nationally. I'll let Philip give a quick overview on his background, and then after that we'll turn it over to Willy Nunn, who is the founder and president of both Homes by West Bay and Casa Fresca Homes, which is a newer concept for him that he can discuss. And then after those 2 gentlemen speak, we'll give you some results of some surveys we've done of what you're seeing in the market, and then we'll end it. So again, we appreciate it. Unlike Bill, who loves Zoom, I'm getting a little Zoom fatigue, being on 3 or 4 a day. But everyone has their options. So hopefully you can hear us okay. And with that, Philip, if you don't mind unmuting yourself, and telling us what you're seeing today on both the construction front, the tenant lease up front, operations front, and maybe touching on going forward, new design of what you're seeing or planning for expansion in the Tampa market, I think the folks would love to hear that.
Hey, thank you, Ryan. I appreciate that reminder. I almost launched off again on mute like I did last week. Bill, thanks for having us. And Ryan, thank you again. So on the framework is based in Tampa. If you don't know who we are, we're strictly apartment developers in the Florida market. We just launched off into South Carolina. We have a project in a joint venture up there right now, but principally the I-4 corridor, Tampa, Orlando, Lakeland, Daytona, down into Sarasota. In recent years, we've ventured more out into lower density, more kind of attainably priced product. As a few years ago, we became a little more concerned with where Class A rents were going, and so we started to stuff the pipeline with a couple of HUD 221 D4 deals and deals in markets that Bill called more hospitable, let's say. And I think that's actually going to be a pretty important point for us to circle back on a little bit later. But on the in honor of my host, I'll talk about land for a second. On the land front, I think there was some expectation that there could be some bargains to be had early on. You know, it was looking pretty dark, and there was really no end in sight. And even though in the face of all this uncertainty now, I'm still really not seeing any real sincere opportunities on the land front. Having said that, just this morning, a seller called me on a large project in Orlando, someone who had been really intractable on timing and price, and called back and said, "Hey, we liked your price, and would you take a small portion of this now instead of the whole thing?" So, you know, maybe some of that hard shell is beginning to soften a little bit on some of these conversations. We'll see how that goes. But I don't believe that there are really any true bargains to be had. There's plenty of cash out there to keep the prices up. And if something were to show up, I think it probably snatched up pretty quickly. So we're not necessarily seeing any real bargains. On the capital markets front, I think that presents some more challenges. On the equity side, we see some reticence, particularly in private equity, to really step back in sincerely. I think on the institutional side, it's the same thing. Although there are some deals getting done, I think they're just there's plenty of cash out there. I think it's just going to be very cautious. As Ryan said, we had a good April and May, or as Bill said, we had good April and May on collections, so that bodes well going forward. On the construction side, and Willy's going to talk a lot about this too. It's interesting to get his perspective on this. We definitely see some drops in commodity prices. My personal belief is that the window of opportunity here is going to be pretty small. I don't see the construction industry continuing to suffer for any long period of time, particularly as we're more going back to work now. So I see a small pricing advantage in a pretty tight window right now for us. So we're trying to act quickly on deals to get them under construction. Fortunately, we had a couple under construction when this whole pandemic happened, and they basically performed relatively unscathed. Just very small supply issues, really no labor issues. It just became a protocol and safety issues on the site that we had to contend with. And then on the property management side, which I want to circle back more on later because there's a lot of detail here that I think is going to impact us later. That was, a serious challenge, working with our property management groups and understanding kind of the new world that they're dealing with and how to educate tenants and how to make them comfortable and safe, and how do you operate a property virtually, how do you virtual tours. It's really kind of completely changed the landscape about how we own and operate these assets, and that's going to evolve even more so in the coming months and years. So that's going to be something to watch very closely. It's going to impact our product type. It's going to impact our amenities. It's going to impact our unit design. And so we're looking at all those issues right now. But that's just kind of an overarching summary, and we'll start from there.
Yeah, I appreciate you mentioning that. I would like to echo Philip that we're seeing the same thing. There's a lot of people looking with cash on the sidelines for those deals, and we're just not seeing any land sellers out there looking to discount their pricing. And contrary to most people's thoughts, we're still getting 2-3 offers, it seems like, a day on properties, and the pricing is market pricing. And the only caveat is there's language in most of these LOIs or contracts that are contingent on COVID or a pandemic being lifted or a national emergency expiring before their diligence period either starts, or with a 30-day extension or tolling that once that expires, then their due diligence expires. So interesting that you're seeing and hearing the same thing. With that, turn it over to Willy and get his thoughts on maybe what he's seeing on the home building side, and a little background maybe too on Casa Fresca, which is a little bit lower price point versus the traditional Homes by West Bay, Willy. And again, we'll open it up to Q&A when Willy's done. If anyone has questions, feel free to shoot them to me, and we'll get them to Philip or Willy.
Thanks,
Willy?
Ryan. And just confirming, you can hear me okay?
Yes, we hear you.
Okay. So as Ryan said, we have two companies, Homes by West Bay, which started in late 2009 and has typically been focused on what I would always describe as what public builders can't, won't, or shouldn't do in terms of price point and option selections and things like that. We run a huge option catalog, build homes that are generally very complicated. I don't really think that Homes by West Bay is a scalable business. We're going to always keep that business in the Tampa Bay area, where we can literally walk out of our office and see what's going on. It's really a high touch business and very complex. In recent years, we've sort of reached the limit of what we think that business can be in Tampa. And it seems like that's somewhere between 400 to 500 homes a year. The good news is we've been pretty successful with that, and the business has thrown off some good cash. And a lot of my management team and I are Centex Homes alumni from the pre-Pulte merger. And we've got a good toolbox as far as building entry-level homes, and decided to start a separate brand similar to Ashton Woods having Starlight Homes. So we started a separate brand, wholly owned subsidiary called Casa Fresca Homes, and we've been delighted with the success of that. And it's a tried and true formula, real high volume production building. We start 2 homes a week and release 10 inventory homes right out of the blocks, and it's been great. It's been great. We've been admittedly fairly selective about our early site selection, but it's not uncommon for us to sell 8 to 10 a month and be out of product before we know it. So keeping lots in front of that operation has been a delightful challenge. And so since the pandemic was declared and in the U.S., we've actually sold extremely well. We are ahead of our original 2020 plan for both companies, and May seems to be off to a great start. And with regards to capital, we tend to internally fund the entire operation with our own equity and committed bank lines of credit. And then for the larger land deals, tend to bring in partners or land bankers for off-balance sheet financing. That's become interesting. Prior to the pandemic, we were floating around in a bathtub full of money looking for deals, and that hasn't changed. And if anything, there's probably more sense of opportunity to look for deals, and I think that's going to keep prices up. I don't really foresee any significant bargains for a long time, if ever, during the cycle, depending on which way it goes. The tricky part has been, in a number of cases, I've said, okay, have a deal, let's go. And then comes the, we're in New York and we can't come to Florida without quarantine. We have to see the asset. So that's a problem. Like any other problem, there's workarounds, and we're moving towards that. So that's been interesting on the capital side. And there's also a lot of, let's wait and see. So I think we're moving towards a moment where everybody's going to collectively exhale, and then there's going to be a lot of capital unleashed. And that could be any day. I mean, we just need a couple more weeks of good sales. We, as Bill showed the slide from John Burns, I mean, Tampa's it. In the East, it's about Tampa. Texas looks good. Phoenix looks great. And we are very lucky to be sitting in literally the best market on the East Coast. And, you know, there are a couple of macro trends that I think are enormous in terms of what are going to really help us. And these are all the accelerations of pre-existing trends, but they're going into hyper. You know, people are just pulling the cord and bailing on Boston, New York, Philadelphia, Washington, you know, at amazing rates. And we've literally had the experience of selling home completed inventory sight unseen to people in quarantined states, and I like literally signing contracts and collecting deposits by wire, and then moving forward. So that's been, you know, really interesting dynamic. So this migration is on, and it's going to be huge. I mean, even a fractional percentage of the, you know, 100 million people that live in the Northeast makes a huge dent in our permit volume here. So you know, that's a big trend. The other thing is working from home. A lot of people just don't have the setup in their houses that some of us do, in terms of they didn't plan on working from home, and they need to make an adjustment. And I don't know when this working from home idea unwinds. I think that one of the, you know, what I'm hearing a lot from folks in the Northeast is they're probably working from home until next year. And I think unless the virus is really gone, or there's a vaccine or something like that, it's going to persist. And part of that's going to be just liability. People are really, a lot of companies are really focused on, you know, employee liability. And I think one of the interesting things to look at right now is what's going to happen with this new $3 trillion aid package that's been introduced by the Democrats in the House. One of the big things that's going to turn on is the Republican push to get essentially, you know, liability immunity for corporations as a result of COVID. And that I think is a key element to reopening a big chunk of the economy, and even returning to the office at all. But regardless of that, I think that you know, working from home is a movement that's here to stay. And I think that you know, if you're a knowledge worker, and you don't necessarily have to be constantly interacting with someone else, or you're not involved in selling face to face, I think you're going to really want to work from home, and at least several days a week. And that's going to have long lasting impacts on mobility patterns and infrastructure needs, all kinds of secondary spillovers.
And with that, Willie, I mean, are you looking at not just employees working from home, but students doing schooling at home? I mean, we're hearing that that's maybe becoming a viable option, which I think would drive my wife crazy. But for a school, crowding is having your kids at home and a certain amount doing virtual. Is that coming into play in the home design or bigger offices?
You know, not so much in the home design, because that's probably more temporary. I think the kids got to go back to school at some point, or again, the economy just doesn't work. If you've got young kids, it's a real challenge right now to have a 2-income family. And a lot of what we're doing is based on people being able to have 2 people working. And it's kind of hard to work from home if you've got little kids running around all the time. So that's just a huge burden. And if you look at Sweden, one of the key things that they've said is, you know, we've got to keep schools open so people can work. I think an interesting thing to consider is more at the university level. I mean, so much of the college experience is being on campus. And again, they're focused on, I think they're focused on liability. You've got University of California system, which is, I think, the largest university system in the country. Doesn't look like they're already announcing they're not going to open this fall except for essentially labs and things that you literally have to be there for, dance and things like that. But other than that, they're not going to be open. And if you're not in a position where you can experience the on-campus lifestyle, there's a lot of universities that are going to get squeezed between, why go to an elite school and why pay elite school tuition if you can't actually be there?
Absolutely. And Philip, if you don't mute yourself in that regard, I know you're not a student housing developer, but on the multifamily side, I would assume the student housing apartment developers are in the same boat as if there's no fall opening. How do they lease up? Typically, that is, they have a big run on lease up for a month before school starts that basically locks them in for a year. Have you heard anything from the student housing developers how they're feeling it? Because I would think they're probably in a pretty rough situation.
Yeah, a great deal of a huge question mark there for the reason that Willie just described. You got a giant system saying one thing and other, mostly on our side of the country, kind of undecided. I've gotten word from a few schools in the Northeast that they're intending to open. So just, I think it's a huge question mark. I do want to echo a couple of things that Willie said. One of them was about in-migration. I completely agree that we're going to probably set some record numbers on in-migration into Florida in the coming quarters. We're obviously on a very aggressive track like that, 1,000 a day back to pre-recession levels coming in now. And anecdotally and just statistically, we're seeing that trend continue. So that's obviously going to change the demand structure, the demand curve on our product a little bit. The second thing that he said that I want to echo, and I think has an immediate impact on our residents, our tenants, no matter if we were to get a vaccine tomorrow, the enduring change to our product design is going to have to be working from home. I mean, even if it goes away, I think we've all had some pretty stark realizations about our effectiveness, our efficacy of our employees and our businesses being able to be adaptable. So something, if we had told, if you said you had to make this change, it would have taken corporations years to figure this out. And then overnight, Twitter says, everybody's working from home, starting from now forever. We can all do it. And I think that's going to put a little different spin on product design for us in the amenity areas and also in the units themselves. So that's kind of an immediate change. And we're looking at what we have in the pipeline right now to make those adjustments.
Great. A question has come in about construction activities. I mean, with what's going on related to COVID, how has this changed both your schedules for construction and costs? So you'll see in the surveys that most people think construction costs are going down due to this, but my guess is that the impact is that there's going to be additional costs with construction tied to this. Are you seeing that? Or if you could share how it's affecting both costs and timeline, that'd be great on both fronts.
I'll answer that first. Really on the schedule front, like I mentioned earlier, we so far we've kind of come through unscathed. There's some rumblings about particular suppliers, cabinet suppliers, things like that could cause us some delay, but that hasn't materialized yet, and we haven't really seen a pinch on labor at all, or people's willingness to come to work. I think it's probably the opposite, a desire to do that. Our construction sites right now happen to be in the exterior kind of vertical stages. So they're all open air. There's, naturally according to distance from one another. We're doing temperature checks. We've got additional sanitation stations, and we're just exercising good judgment when it comes to meeting more outside with the subcontractors and that sort of thing. So just practically sort of common sense effective measures, but from a scheduling standpoint, I would say really no material change. From a cost standpoint, if there are long-term hard cost implications to this, let's say the building code changes with respect to ventilation requirements, that's going to be a long-term cost. I don't really see any immediate changes because of slowdown in activity or anything like that. Willie might have a different perspective, but that's just what we've seen so far.
Yeah, so far on the supply chain, we've had some inconveniences in cabinets and windows, which hasn't been terribly, we've been able to absorb in our existing schedules. The guys just need to order stuff sooner and manage through it. The two best practices that have clearly emerged, and I'd really like to thank both D.R. Horton and Lennar for really taking a lead on disseminating these best practices locally, along with the Builders Association, and basically we all snapped this into place overnight, which is basically one trade in a house at a time, period. So if the AC guy has to come back and tweak something, then it's on our construction manager to tell the electrical guys to leave the house for 20 minutes. And that's just how that is. And I think our field guys, they're used to seeing a lot of things fly by them really fast, and they're never really sure what's real and what's not. So we had to kind of tell them, hey, this is real, and you're going to really have to do this. And, I know you're going to get pushback, but don't worry. In about 3 days, they're going to hear the same thing from every builder in town, and bang, that was in place. The other thing is the sanitation stations that Philip mentioned. Some grumbling about how that happens, but you know what? They were all in place in a week. So that's been moving pretty quickly. I don't think we're seeing a big labor problem yet, but I think one of the things we haven't talked about yet is the fact that interest rates, 30-year mortgage interest rates now start with a 2. That's incredible. And I think as the lockdown unwinds and people get out and about and the virus abates over the summer, I think we're going to see the best selling season of this cycle this summer. And with that, I think you're going to see some labor issues come fall as people try to get everything done for year-end closings. So, I think it's going to be an exciting ride for the next few months.
And you said May's off to a great start, which we love to hear. And there's been some builders that have echoed that to us. I mean, are the leads it's all being driven virtually? Is it, outreach without giving away your secret sauce? How are you driving this traffic and the design center that is so vital to Homes by West Bay? How is that being used and taken into account for these buyers?
Yeah. So one of the things that I got from a John Burns call a couple of weeks ago is, don't look for new trends out of this. Look for the acceleration of existing trends. That's really a good thought. I mean, outside of the obvious, hyper cleaning that protocols that we've all gone to, understandably, the move to initially shopping online for everything, and certainly for houses. I mean, that's old news. So everybody was pretty much starting their home search online. What we've noticed is the average time spent online has increased reasonably significantly. So people are making a more thorough search online before they visit, and you also see that on the other end, in that our conversion rates have gone up dramatically. Where we might have, floated between a 9 and an 11% conversion rate, now we're in the 20s. So effectively, conversion rates have doubled as a result of this. Meaning, if you come into the model center, you sign a contract twice as often as you used to.
That's great. And a couple of questions with, lower rates being great, raised credit scores, how does that balance out? And then on the other side, and I don't know how, I know this doesn't really apply to Philip, but CDDs rates are so low, yet there's some CDD offerings out there, and the rates we're hearing are, Wall Street is not seeing the same rates that maybe a home builder is seeing. So how do you see that taken into account on
Yeah,
CDD?
that's a big issue. So what effectively what you're seeing are credit spreads. So the underlying base rate for risk-free money is essentially zero, and even out 10 plus years, it's essentially it's a 0.5%. But given the uncertainty, yeah, credit spreads are significantly higher across the board. That's why, I mean, mortgage rates should be even lower. And as declaring effectively mortgage forbearance for up to a year for anybody without showing hardship, that shocked the mortgage system. And it's taken a couple months for the mortgage market to basically go from 3.5 to 3, just under 3. But in reality, if historical spreads held, we might be looking at 2.5 or 2.25 interest rates for mortgages. So credit spreads are a real issue, and it's all about this disruption. With respect to the CDDs, I'm not in the market right now, but I think that market's pretty well disrupted. I mean, it may be difficult to even find a buyer for the bonds right now. So there's a lot going on there, but I think as things stabilize, that'll return to more normal patterns, and hopefully.
Philip, a question came in, and I don't know if Philip and Willie, if you're seeing these questions, but a question came in terms of the design touch points with, multifamily elevator capacities, things like that. Are you seeing lower density or smaller elevators, more elevators? How are you going to take that into a design account going forward on the traditional higher density product?
Yeah, that's a really good question. And it kind of speaks to this in-migration thing. Or if you're moving down from New York in the city, are you willing to move back into a high-rise in downtown Tampa, or are you making completely different housing choice? That remains to be seen. And I think, some of the elevator protocol that's happening right now in office buildings around the country are just, taping off the elevator into 4 quadrants, and you can only fit 4 people on, and somebody's wiping down the buttons continuously and that sort of thing. It's again, how long this is going to last, we don't really know. Maybe our comfort level increases and you can't get on without a mask, and who knows what the protocols are. I think it's really up to each property, up to each location to figure that out. Would we be designing more elevators? I don't know that I would design more than I probably would. If you have a high rise, you can't really afford multiple elevators to add elevators that you don't need. We definitely have lower rise projects that have elevators in multiple buildings, and that kind of speaks to spreading things out a little bit. One of the things we did recently in a project completely unrelated to this, but I guess it was just sort of one of those better lucky than good things. We separated all of our amenities to where there were smaller amenities, but they were in each building. So each building has places to work. Each building has a coffee bar. Each building has a fitness area, which I think probably will speak pretty well to maybe some of the new sensitivities. But the other touch points are going to be important. Do we need to go to grocery style doors at all these clubhouses? The frequency of cleaning and all of them has changed overnight. Fitness areas are going to change that protocol. I'm wondering if we just kind of permanently make this change to smaller areas so you have fewer people congregated, or more outdoor areas that say have, those humidifying fans that can keep an outdoor area sort of cool and well ventilated. Maybe that's in shaded. That could be an option. So we're really studying everything touchless faucets and, just ways to minimize transmission, and also just to be really sensitive to everybody has a different level of sensitivity to this. So you're gonna have residents that come in and really want that's going to be the very first thing you get asked about and the most important thing in their mind, and you're going to have to respond to it. And certainly there are going to be people who just really don't care much about it and want to live their lives the way they want to live their lives, and that's fine too. But we have to be ready on our side to really really speak to both ends of that barbell and do our best. On the management side, it's going to take more people and more effort and more cost to operate these buildings. And so that's something we still haven't really quantified yet. I think the property managers are really scrambling around to figure out what's the best balance to strike and how we do it, and working with us to try to figure out what our tolerance is as well.
Well, with that, I mean, it's been about 40 minutes and we don't want to hold everyone's time. If there's any additional questions, feel free to keep sending them. I'm going to quickly run through our slide survey, just so some folks that filled out the survey can kind of see what their peers are saying. So I'm going to do that now. Give me 1 second. So hopefully you can see that. So we asked the home builders, and we had about 25, 30 of them respond. Quickly, 9 quick questions regarding your company sales plans. Where are you at? You can see that the majority are below their projections, though 30% or so are saying they're at projections. So nobody has said they're exceeding projections, though I think Willy may have said that he had his best week ever last week and beat his projections. So Willy missed the survey, but found that interesting, just depending on who you are, because we're hearing that the Tampa market is really rebounded quickly in that sense. When it comes to closed raw land deals, have you actually closed on any between April 1st and now? And there's been some folks that have, most have extended or terminated. More of what we're hearing is that if it was finished lots, we're closing on finished lots. If it's raw land, we're trying to extend or terminate. So that is not shocking. New development opportunities. Are you still looking at deals? Are you on hold? And the vast majority of folks are still contracting sites and moving forward with new acquisitions. And again, that's something that Bill and I would echo, because we are still getting offers and talking to folks. The closings have slowed down and been pushed out, but the offers continue to come in for new deals due to the timeline. And no, we haven't really seen any of the offers at lower pricing per unit, taking into account projected impact fee increase on the residential side, which is somewhat intriguing. So I found this next question very ironic, because your company laid any employees off, and 63% said no, not one layoff, which I don't know if those are, or 95% said not one layoff. I don't know if that's a fib or the people that were laid off just didn't get the emails to answer the questions. So, because we're hearing there have been some layoffs in as 5 to 20% in some cases at the home builder locally. So that was interesting. Labor supply, similar to what Willy said under the other category, that was the majority. It's probably my fault. They have seen no change. So I think that's what Willy had said, is there really hasn't been any change on the labor supply side. Next one, concessions, incentives. Most are holding the prices constant. I found that somewhat intriguing that they're holding constant. They are not discounting it. No higher fees to the brokers. So, but I guess Florida is still a very good market, or Tampa is. So, COVID-19 construction costs 60%, expect a decrease due to that. And with the short-term future for the Tampa market, 50% said it's yet to be determined how we shake out. With 22% thinking we still have great fundamentals. I mean, we're very bullish on Tampa compared to Orlando or other parts of the country. We're hearing that Tampa's the spot to be, and so we're very fortunate that we're in this sub-market. Now, I also heard this morning that they're talking about, hurricane season is around the corner, and they're already talking named storms out in the Gulf, so that hopefully we keep those off of the news and off the radar this season, and keep shining bright on Florida. So, and the last question we asked the home builders was, 6 months from now, where will we be? And 50% said, unemployment over 10%, and 27% said in a recession. My guess is if unemployment's over 10, you're probably close to a recession. So everyone's kind of on the same point, sentiment-wise, but with no severe depression, which is nice to see. So those were what we're seeing. I don't know if Willie, if you contradict any of that, but that's what your peers are sharing with us.
Reasonable. Yeah.
On the next set of questions, we kind of have similar questions to the apartment folks. The first couple were just answers, questions. So we just asked, same thing, since April 1st, have you closed on any land deals? We had 17 responses, and you can see the responses. One group closed on a deal, another closed on an opportunity zone deal, but then everyone else was no, extension. So, and that's what we're seeing. I mean, we average 1 to 2 sales a week as a firm for the last 5 years, and we closed one deal last month, and we've closed one deal in May. So we're down as well. Everything is being extended. So May rents. This was the positive one. How many people didn't pay? I would hope that those 92 and 95% just read the question wrong, and that was the actual paid rent, not how many people didn't pay for the Tampa market. So it looks like 5 to 10%, which doesn't seem. And maybe Philip, you can answer. I mean, I would think at any given month, whether it's COVID or not, there's 4 or 5% delinquency in an apartment deal. So it didn't seem bad for what we're seeing in Tampa.
No, I think, in our portfolio, we saw low single-digit numbers. And actually May collections were better than April. And when you're talking low single digits, you're talking, just a few people that you're working with to structure payment plans, increase the term of their lease, stretch out a payment, something like that. So it's not been zero impact, but it was far less than we had feared, for sure, and less than we expected. So that was a great outcome, actually. And so long as we can get back to work, we don't really expect that this will change dramatically. Obviously, if things take a turn for the worse, this would be a big concern in the long term.
Yeah, and the next one was incentives, concessions for lease up, and it looks like a couple of the folks, 3 or 4 of them are giving them, but the majority in Tampa are not, or are watching it closely. So I found that we would have thought there would have been more concessions, but I guess it depends on where you are in the cycle. If you were fully leased up and just renewing, maybe you're not as motivated as if you just delivered a new project that needs to do full lease up. When it comes to new apartment developments, are you on hold? And 50% of the folks said no, they're continuing to contract sites, business as usual. So that's what we're seeing as well. The only folks that we're seeing, again, I hate to be repetitive, is that the only folks that are really feeling this on the land acquisition side are folks that were in the window of closing within 30 or 60 days. Those are the folks, or due diligence expiring. Those are the folks that we're seeing that really are feeling it. Everyone else is continuing to be cautious and look for more time, but make offers on sites. So construction pricing, similar to what the home builder said, is that 78% expected to come down. So everyone wants land to come down and construction pricing to come down, and that'll make it work. So hopefully we'll see if that happens. New deals today, biggest concerns is underwriting for lease up and rent absorption. So I'm sure that it's not a shocker, but that was really the big gist of 80% of the folks surveyed. So next question was on construction lending. Looks like 30% said they were on hold, or 26% still funding. What we're seeing is that they're all on hold, but on the deals we're working on, or at least that's what our buyers are telling us. So hopefully that's changing, loosening up now with the better May rents that may be projected, that they'll get some comfort level that, hey, we can fund this deal because it's going to take 18 months to build it before we're turning it over, and that it'll get done. Where do you see the Tampa land market for apartment development in the future? And 60% said yet to be determined. I mean, I found that interesting because, you know, again, we're bullish on it, but it's good to hear what folks are saying. And then 6 months, where will the U.S. be? And again, this is a very similar response to the home builders that either in a recession or unemployment will be over 10%. So with that, those are kind of the quick questions that we asked the home builders. And, you know, there's a couple more questions. I don't know if Philip and Willy have time for a couple more questions or if we want to just end it.
I wouldn't mind. I'd like to answer Sanjay's question.
Absolutely. Go for it.
You know, the questions about with land prices not really moving and labor staying the same, how do you afford to build affordable multifamily with affordability just getting tougher and tougher? You know, that is our biggest issue in our industry. We just talked about something we didn't talk too much about, but touched on was rent growth. I don't see that we're going to have really measurable rent growth in the quarters ahead. Absorption and lease up and concessions, those are all areas that our lenders and our equity partners are going to want to see us account for. And so that's going to put pressure on the financial performance of these deals, even with low lending rates, which are very attractive. Obviously, if you've got an existing asset, but new construction, you know, I think the advantage of those lower rates is going to be kind of offset by a lot of these other things that we're going to have to include in order to get these underwritten. The question, how do you afford to build affordable? You know, Bill mentioned it earlier. One answer is go to areas that are more amenable to working with you as a developer. You know, we had really a tremendous experience with the city of Lakeland. It was city-owned land. It was an RFP process that we won, but they stepped up when it came to helping us out with a temporary tax abatement program and some help on impact fees because they wanted to see 400 people live in their downtown. They understood the long-term economic benefit to them of having that downtown. And you contrast that with you know, a huge projected rise in impact fees here in Hillsborough County, while at the same time you have a big affordable housing problem. Those are irreconcilable equations. So one is not helping the other. And when you have, if you know, we were just talking about last week at ULI, talking about how these cities and municipalities are going to see really big budget issues coming ahead with decreasing tax revenues. And we just got in Hillsborough County in our markets to a place where they're really acutely aware of the need for affordable housing, but it's going to be harder, I think, for them to participate financially going ahead if things stay the way that they are. So it's a very, very, very tough problem. And you know, supply is one answer. More available units is going to drop pricing. You know, if I'm not going to be building any new high rises right now, that's for sure. I'm not going to be playing in the $2.50 to $3 a foot market. We're going to be playing in the markets that I mentioned earlier in the call. So it's a good question, Sanjay, and that's why we get up every morning, try to figure that one out.
Hey, Bill, I think there was a question for you about office and the future of that. And I think I'd certainly like to hear the answer to that as well. What do you think?
And Bill, you're on mute, so you need to unmute yourself, Bill. I mean, I can give you my thoughts on it, Willy. Is that there'll be less demand for office space. So we've heard some folks, you know, that likely will take less space, but that some of the office developers are thinking that some of the neighbors will then expand because they will have been planning putting a person every 120 square feet, and now they need more space so that their staff can come, and that they'll expand actually their office space requirement to give a little bit more spread out. And that most people are proud of their office and like leaving their house, don't want to be there with the kids and the wife, or kids in the house that I don't want to point out wives or husbands, but I'm speaking personally. 3 kids under 5, my wife's the same to put up with it, that, you know, there'll be more demand for office space with more spread out versus all the cubicles. So, and Bill, I see you're now off mute. So
yeah, we are. Thank you. we have had some inquiries. It has not led to any offers or so forth, but we've had some inquiries, again, going back to the traditional suburban one-story office buildings where you get nice spacing for the employees, and you pull up and you walk in, there's no elevators to deal with, and you're dealing with only your own space in your building or half building. So we think there'll probably some emerging, I'll call it the John Westfall Waterford development product that we all became so familiar with in the last cycle out there in that suburban locations. I know we had Bill Rosetta on a ULI call the other day, and Bill bought a parcel from us up on 54. He's been working vigorously through this downturn to get his permits because Bill thinks that there will be tenants for his building out on State Route 54 there near the Suncoast Parkway when this is all over. So I don't know if he's done any redesign. I haven't had a chance to talk about that, but I think we're going to see a couple 100 square feet per employee and some activity back in the market that had seemingly gone away for a while. I've heard on some of these other webinars, haven't talked to Dan over at Highwoods yet, but I heard him speak. The whole redesign of office buildings and how they handle air and air circulation and all those kind of things are subject to discussion, but I don't think anybody has any answers yet about what that's going to cost, how they get it in the rents. We're already in a battle here where costs were getting so high that the rents weren't keeping up with new construction in the West Shore marketplace, for example. So it's going to be a big change, and I think Willie said it early about the working from home is here to stay for some. I, for one, have finally decided I don't have to be the first guy in the office every day at 7 a.m. Philip Smith and I and Willie all talk before 7 a.m. lots of days, but I can do a lot of work from home and get in here at 10 o'clock when traffic, and of course traffic's beautiful right now, but so just some fundamental changes that I see personally. I think other people in the marketplace are also going to experience we can do things differently when we come out of this, so we've learned from it. I've learned to buy big things like pressure washers online and have them dropped to my barn. I don't have to go for an hour drive to Tractor Supply and haul it home. So just kind of cool stuff that's coming out of it. None of us wanted to be forced into it, but since we were, we might as well make the best of it. So that's kind of my pitch. And Ron, I think we're right up on top of the hour just about. So turn it back to you.
I would just echo that the clean is the new green. Everyone wanted LEED certified back in the day, and now, I mean, I know with what Jeff Innick is doing, he's got his whole project in downtown Tampa is going to be, well certified through Delos. That may be the new thing, is that people want to live in a really clean building with great, fresh air, and that may be the new clean is the new green. So we'll leave it with that. I would like to thank our panelists very much, Philip and Willie, for your time. We really appreciate your thoughts and candor, sharing with all the attendees, everyone who spent the hour with us. Thank you. And of course, be remiss if I didn't thank our entire team, Chris, Bill, Jack, Michael, support staff, Chrissy, and Catherine. We're all in the office ready to do deals. And if you have any follow-up questions or emails, feel free to reach out to us. And this has been recorded, so happy to send out a link if anyone needs it. And with that, we will end it. Thank you all. Have a very productive day, and take care.
Thank you all.
Make it a good one. Thank you.